Have you ever thought about investing, but didn't know where to start? Well, you've come to the right place. I am Mr. Finance, and in this video, we'll demystify the world of investing for you. By the end, you'll have a solid understanding of the basics, the importance of setting financial goals, understanding risk tolerance, the different types of investments, and much more. So buckle up as we embark on this exciting journey to financial growth and independence. Stay tuned to understand the basics of investing. Let's start with the basics. What exactly is investing? Well, investing is akin to planting seeds today in the hope of harvesting a thriving garden in the future. When you invest, you're putting your money into assets like stocks, bonds, real estate, or businesses, with the expectation that over time these assets will grow or generate income. Think of it like this. Rather than letting your money just sit in a bank account, you're putting it to work. You're giving it a job, and that job is to grow and make more money. By investing, you're aiming to increase your wealth over the long haul. Different assets come with different levels of risk and potential return, and it's essential to balance these factors based on your financial goals and risk tolerance. So, investing is all about making your money work for you. Now that we know what investing is, let's understand why it is important. Investing is not just about making more money, it's about securing your financial future and making your money work for you. It's about taking control of your financial life and making decisions today that will pay off in the future. When you invest, you're giving your money the potential to grow, to outpace inflation, and to build wealth over time. One of the most powerful aspects of investing is compounding. Compounding is the process where the returns on your investment generate their own returns. It's like a snowball effect. Your capital grows larger and larger over time, accelerating your wealth creation. But here's the catch. Compounding isn't an overnight miracle. It's a long-term game. It takes time. That's why starting early is so crucial. The earlier you start investing, the more time your money has to grow, the more you can benefit from compounding. Remember, the earlier you start investing, the more you can benefit from compounding. Before you start investing, it's essential to set clear financial goals. Why is that, you ask? Well, setting financial goals is like using a compass on an adventurous journey. It can guide you towards making informed decisions that align with your aspirations and risk tolerance. Think of it as your personal roadmap. Are you saving for retirement? Perhaps you're aiming to buy a home, fund your child's education, or take that dream vacation. Whatever it is, having a clear goal in mind helps you determine which investment vehicles to use and how much risk you should take on. Remember, financial goals are not static. They should be revisited and adjusted as your life circumstances change. So don't worry if you're unsure about your goals right now. It's okay to start with a broad goal and refine it over time. Having clear financial goals will guide your investment decisions. With these guiding stars, you're one step closer to a successful investment journey. Every investor needs to understand their risk tolerance. Risk tolerance is essentially the degree of variability in investment returns that an individual is willing to withstand. Think of it as your financial comfort zone. It's influenced by several factors, including your financial situation, investment goals, and even your emotional comfort with risk. So, how do you assess your risk tolerance? It begins with self-reflection. Consider your financial goals and the timeline you have to achieve them. If your goals are long-term, you might be able to tolerate more risk. Conversely, short-term goals may necessitate a more conservative approach. Your emotional comfort with risk is also crucial. How would you feel if your investments declined in value temporarily? Would you panic and sell? Or would you hold on, knowing that markets can fluctuate? Remember, higher potential returns often come with increased risk. Understanding your risk tolerance will help you choose the right investments. It's about balancing your desire for returns with your ability to endure potential losses. There are so many types of investments available. Let's explore some of them. First, there are stocks, which represent a share in the ownership of a company. By buying stocks, you become a shareholder and can earn profits from the company's success. Then we have bonds. Bonds are basically loans you give to companies or governments. In return, they agree to pay you back with interest after a certain period. Next up is real estate, where you invest in physical properties like houses or commercial buildings to earn rental income or sell at a profit later. Mutual funds and exchange-traded funds, or ETFs, are ways to invest in a broad range of stocks or bonds at once. They offer diversification and are managed by professionals. Other options include commodities like gold or oil, and even cryptocurrencies like Bitcoin. Choosing the right type of investment depends on your financial goals and risk tolerance. One key principle of investing is diversification. Now, what does diversification mean? In simplest terms, it's the strategy of spreading your investments across various asset types such as stocks, bonds, real estate, and more. Imagine it like this: you wouldn't want to put all your eggs in one basket, would you? The same applies to investing. By investing in a mix of assets, you reduce the risk associated with putting all your money into a single investment. If one asset doesn't perform well, you have others that might. Diversification doesn't guarantee profits or protect against all losses, but it can help manage risk and potentially improve returns over the long term. It's like a safety net, catching you when certain investments fall. Building a diversified portfolio doesn't have to be complicated. Start with a mix of different asset classes and gradually add more to balance out the risk and reward based on your financial goals and risk tolerance. A diversified portfolio can help spread risk and increase your chances of success. Now let's discuss where you can invest. Investment accounts and platforms. These are the vehicles that will carry your funds into the world of investments. First, we have the traditional brokerage accounts designed for buying and selling securities like stocks, bonds, and mutual funds. Then there are retirement accounts such as 401(k)s and individual retirement accounts or IRAs. These are tax-advantaged accounts specifically designed to help you save for your twilight years. But in this digital age, online investment platforms have also gained popularity. They provide a convenient way to manage your investments, right from the comfort of your home. These platforms often offer a wide range of investment options, from individual stocks to exchange-traded funds and even robo-advisors for automated investing. Remember, each of these accounts and platforms come with their own set of features, fees, and benefits. So do your homework before choosing. Choosing the right platform or account can make your investment journey smoother. Dollar cost averaging is a strategy that can be beneficial for beginner investors. Let's explore this concept. Imagine you're buying a certain type of investment on a regular schedule, regardless of the price. You're not trying to time the market or buy low and sell high. Instead, you're consistently investing a fixed amount. This means you buy more shares when prices are low and fewer shares when prices are high. Over time, this strategy can result in paying a lower average cost per share, hence the term dollar cost averaging. It's a disciplined approach that takes emotion out of investing, making it particularly useful during market ups and downs. The benefits are twofold. It encourages regular saving, and it reduces the risk of making a substantial investment at the wrong time. So for those who are new to investing and maybe a bit apprehensive about market volatility, this could be a smart strategy. Dollar cost averaging can help mitigate the impact of market volatility. Effective risk management and thorough research are crucial in investing. Risk management isn't about avoiding risk altogether, it's about understanding and managing it. It's about making sure you're not putting all your eggs in one basket, and it's about being prepared for the unexpected. Next, let's talk about research. Before you invest in anything, you need to know what you're getting into. This means understanding the company or asset you're investing in, its market, its competitors, and its prospects for growth. Also, keep an eye on the wider economic and political landscape. The best investors are always learning, always curious, and always critical. Lastly, remember to keep a close eye on your investments. Monitor their performance, but don't be swayed by short-term fluctuations. Stay focused on your long-term goals, and don't be afraid to adjust your strategy if circumstances change. Remember, informed decisions are the best decisions. That's a wrap on our beginner's guide to investing. We've journeyed through the essentials, from understanding what investing truly is, recognizing its importance, to setting clear financial goals. We've explored the various investment types, the need for a diversified portfolio, and the power of dollar cost averaging. We also touched on the significance of risk management and continuous research. Remember, the journey of investing is a marathon, not a sprint. Take your time and make informed decisions. If you found this video helpful, then please feel free to leave a like, comment, and subscribe to the channel.